Most people lose money not because they pick the wrong investment, but because they pick the wrong investment for them. That's the truth no one talks about. You can copy the exact portfolio of a successful investor, follow every single step, and still fail miserably. Why? Because if it doesn't match your risk personality, you won't stick to it. You'll panic when the market drops. You'll get bored when things move too slowly. You'll jump in and out at the worst possible times. That's why understanding your risk profile is more important than picking the perfect stock or ETF. It's the foundation of every long-term investment strategy that actually works. And at the end of this video, you'll know how to identify your unique risk type and how to align your investments with it, so you never feel lost or anxious when markets move again. Let's break this down. Everyone talks about risk tolerance, but it's not just about how much risk you can take. It's about how much risk you can take without losing sleep. You see, there are people who say they're aggressive investors until they see their portfolio drop 20% and suddenly want to sell everything. On the flip side, some people are ultra-conservative, sitting on piles of cash while inflation eats away at their savings because volatility scares them to death. Both are dangerous traps. And both are avoidable if you know your investing personality. There are typically three dominant risk types. First, the conservative investor. They prioritize safety. They prefer slow but steady growth, and they hate losing money. Even small drops make them nervous. For these people, index funds, bonds, and dividend-paying stocks feel safe. The key is to give them predictability, not performance. Then you have the balanced investor. They want growth, but they also want peace of mind. They're okay with some ups and downs as long as there's a plan behind it. A well-diversified portfolio across stocks, bonds, and even real estate works perfectly for them. They don't need the highest return, they want consistent progress. And finally, the aggressive investor. They chase opportunity. They're willing to stomach big drops if it means bigger gains over time. These are the people who thrive with high-growth stocks, crypto, startups, and leverage. But even they need structure, because risk without a strategy is just gambling. Now, here's the twist. Your risk personality isn't fixed. It evolves with your income, your age, your goals, even your life events. That's why you can't copy someone else's portfolio from Reddit or TikTok and expect it to work for you. That's not investing, that's impersonation. What you need is alignment between who you are and how you invest. And in the next section, I'll show you how to build a portfolio that matches exactly that. Without guesswork. Without stress. So how do you actually build an investment strategy that aligns with your personality? It starts with one simple concept. You are not your neighbor. You are not your friend. You are not Warren Buffett. You are you with your own financial goals, fears, habits, and instincts. The goal isn't to suppress your personality. The goal is to leverage it. Let's say you're someone who gets anxious when markets are volatile. You open your investing app 5 times a day. You feel physically sick every time you see red numbers. That's not a sign of weakness. That's a signal. You need an investing system that removes emotion from the process. One that automates decisions so you don't have to constantly manage fear. For someone like that, the right move could be setting up automatic investments into broad market index funds, weekly or monthly, so you're not tempted to time the market. Even better? Pair that with a rule. I won't look at my portfolio more than once a month. That one habit could save you thousands over the years. Now imagine the opposite personality. You love taking risks. You get bored easily. You want to be in the game, not just watching from the sidelines. If that's you, being 100% in bonds or slow-moving ETFs is a recipe for quitting. You'll lose interest. You'll abandon the plan, which means you'll underperform, even if it's a safe strategy. Instead, you need something that stimulates your curiosity and gives you a sense of control. That might mean allocating a small portion of your portfolio, say 10%, to high-growth plays, individual stocks, or even crypto. The key is keep it contained. Let your risk-taking instincts breathe, but inside a box. That way, you're not betting the farm every time you get excited about a trend. And what if you're somewhere in the middle? You want to grow your wealth, but you also want to sleep well at night. You're not afraid of short-term losses, but you also don't like roller coasters. This is where asset allocation becomes your best friend. Imagine building a portfolio like a meal. Stable proteins, bonds, cash equivalents. Complex carbs, dividend-paying stocks, real estate. And spicy sauces, growth stocks, tech, international exposure. You're not putting all your chips on one outcome. You're designing a system that fits your emotional budget, not just your financial one. Now, here's something most people never consider. Your risk tolerance can vary by goal. You might be ultra-conservative with your retirement savings, but aggressive when it comes to investing for your side hustle or a future house. That's not irrational. That's strategic. Think of each financial goal as its own mini portfolio, its own risk setting, and align each one with your emotional capacity to handle loss in that context. This is how high performers operate. They don't ask, what's the best investment? They ask, what's the best investment for this purpose, given how I respond to risk? Because the truth is, no portfolio works if you abandon it at the wrong time. The goal isn't to be fearless. The goal is to never get scared out of a good decision. And the only way to do that is to invest in a way that reflects who you really are. Now that you know the why and the how, in the final part, I'll walk you through a step-by-step framework to identify your own investor type and build a simple, personalized investing system that works even when emotions run high. All right, now you understand why risk personality matters and how to match your strategy to your emotions. But let's make it practical. Here's how you actually build an investing system based on your unique psychology. Start with a gut check moment. Think back to the last time the market dropped significantly. Did you feel calm, curious? Or did you feel like cashing out and never looking back? Be honest. Your real reactions during stressful times reveal more than any online risk quiz. Now ask yourself, when it comes to money, do I value stability, growth, or freedom the most? Stability-driven investors tend to avoid big swings. They want to know their money is safe, even if the returns are modest. Growth-driven investors are focused on maximizing returns. They can ride out the noise if the long-term outcome is bigger. Freedom-driven investors want flexibility. They don't mind risk if it gives them options, like retiring early or funding a passion project. Once you identify what drives you, you can start shaping your portfolio around it. Let's get tactical. If you value stability, you might build something like this: 50% bonds or bond ETFs, 30% large-cap dividend stocks, 20% cash or money market funds. You won't see explosive returns, but you'll rarely lose sleep. If you value growth, you could go with 60% broad market equity ETFs, 20% international or emerging markets, 20% growth-focused funds or sector plays like tech or AI. Yes, you'll see swings, but long-term, you're positioned to win big. If you value freedom, your portfolio might be more dynamic. 40% core index funds for safety, 30% real estate or business investments, 20% speculative assets, startups, crypto, innovation, ETFs, 10% cash for optionality, so you can act fast when opportunities appear. The beauty is, all of these models are valid. None is better than the other. They're just designed for different personalities. But here's what's non-negotiable: consistency. Once your system is in place, stick to it. Rebalance when needed. Check in once a quarter, not once a day. Because the real risk isn't market volatility. It's you sabotaging your own plan when fear kicks in. Want a quick way to test if your strategy fits your personality? Here's the rule. If you can imagine yourself holding your portfolio through a 30% drop without losing your mind, you've likely found your fit. If the thought makes you panic, it's too aggressive. If it makes you bored, it's too conservative. Adjust until it feels challenging but not unbearable. That's your sweet spot. And one more thing. Don't be afraid to evolve. As you grow, financially and emotionally, so should your strategy. The risk-tolerant 25-year-old version of you might become a cautious 40-year-old, or the other way around. What matters is that your investing style keeps reflecting who you are now, not who you were or who someone else thinks you should be. So here's your challenge. This week, sit down and assess your actual reactions to risk. Not your theoretical answers, the real ones. Then take a hard look at your current investments. Do they match your behavior or fight against it? If they don't align, it's time to redesign. Because the most powerful investment strategy isn't the one with the highest return. It's the one you can stick to for decades. If you want more content like this, hit that like button and subscribe. It helps more than you think. Check out our last video on how to build a portfolio with just $100. And drop a comment if you want a deep dive into how to rebalance your portfolio without overthinking it. Remember, the sooner you align your money with your personality, the faster you build real wealth.